Have you ever wondered why some traders earn consistent profits while others, even with the best trading tools, still fail? The secret doesn't lie in the strategy or software you use, it's in your mind. In this video, we'll explore how to master trading psychology to achieve stability, drawing on ideas from trading psychology expert Mark Douglas, author of Trading in the Zone and The Disciplined Trader. Together, we'll learn how to overcome psychological traps and turn trading into a game of probabilities, maximizing profits and minimizing stress. The profit gap. What's stopping you from winning? Imagine having a powerful trading tool, one that gives you high probability buy-sell signals. You see the clear signals, yet your results don't meet expectations. This is what Mark Douglas calls the profit gap, the difference between the potential of your trading system and your actual results. According to Douglas, the problem isn't your tools or the market, it's how you execute your strategy. Many traders fail because they let emotions take control. For instance, you might enter a trade without setting a stop loss, or exit too early because you're afraid of a reversal. These mistakes stem not from your method, but from emotions, fear of loss, greed for bigger wins, or pressure to be right. To close this gap, you must develop psychological discipline, the ability to follow your trading plan without emotional interference. Action step: treat trading as a process, not a one-time win or loss. Focus on executing your plan correctly, not obsessing over each individual outcome. One of the biggest barriers for traders is expecting every trade to win. Douglas emphasizes, trading is a probability game, not a prediction game. Even if your strategy has a 60-70% win rate, each individual trade is still random. Think of it like flipping a weighted coin. You know it will land heads 70% of the time over many flips, but you can't predict the next single flip. For example, you buy a stock at $100, expecting it to rise to $110, but prices move only when others are willing to buy higher. And you can't know who they are or when they'll appear. Trying to predict each trade will only bring frustration when you lose, or make you exit too early when you win. Instead, accept randomness and focus on the long-term edge of your system. Real-world comparison. Think like a casino. Casinos don't need to win every hand, they just need a statistical edge across thousands of games. Professional traders do the same. They trade in series, not one-offs. Action step: commit to executing at least 20 trades strictly by your method without skipping any signals. Evaluate your overall results, not each trade individually. A common mistake is treating trading like a right versus wrong game. You see a perfect setup and think, this one will definitely win, but when the market goes against you, you feel betrayed and refuse to cut losses, because admitting loss feels like admitting you were wrong. Douglas calls this the pain avoidance mechanism. You seek confirmation of your belief and ignore danger signs. For example, you buy a stock based on good news and a strong chart. When it drops, you cling to the news and ignore the clear downtrend, leading to unnecessary losses. Or in a winning trade, you exit too soon because you fear losing profits, missing out on bigger gains. The solution: trading isn't about being right or wrong, it's about probabilities. A losing trade only means others didn't share your belief in that moment. Accept it and move on. Action step: before each trade, ask yourself, how much am I willing to lose to test whether the market agrees with my analysis? Define your stop loss before entering, and stick to it. Professional traders don't try to predict outcomes, they focus on risk management and exit planning. Douglas suggests asking 3 key questions before entering a trade. How much am I willing to risk on this trade? If the market moves against me, how far will I let it go before exiting? If it goes in my favor, how will I take profits, all at once or by trailing stops? Example: you buy at $100, set a stop at $95, risking $5 per share, and plan to take profit at $110 or trail your stop upward. This structure lets you control risk and maximize reward without emotional interference. Real-world comparison. Think of trading like playing a slot machine. You put in $1, you know that's your risk. If you don't win, you don't feel betrayed. You just play again. Trading works the same way. Define risk, execute the setup, and wait for the outcome. Action step: practice placing both stop loss and take profit levels before every trade. Start small, e.g. in $5 per trade. When you can lose calmly, gradually increase your risk size. To trade effectively, you must reach a neutral mindset. No fear, no hesitation, no obsession with winning or losing. Douglas calls this the state of a professional trader. They see a signal, enter, manage risk, and move to the next trade, emotion-free. How to reach this state? Accept losses as normal, not personal failure. A losing trade only means others disagreed with you, nothing more. Focus on the process, not the outcome. Executing correctly is more important than guessing right. Train gradually. Start with demo trading to build familiarity. Then move to live trades with small size, e.g., 10 shares, $0.50 risk. When you can execute flawlessly without fear, scale up. Real example: a trader earns consistent profits on demo, but freezes up when trading real money. The difference: psychological distance, calmness in demo versus anxiety in live trading. The goal is to narrow that gap through mental conditioning. Action step: trade small and focus on discipline. Journal your emotions after every trade and adjust your mindset to eliminate fear or unrealistic expectations. Many traders believe that learning more about markets, technical indicators, news or charts will make them successful, but Douglas insists, understanding yourself matters more than understanding the market. Trading tools can give you an edge, but if you can't control your emotions, that edge is useless. Imagine having a high-performance race car, your strategy, but driving it while panicked or overconfident. The result? You crash or underperform. Trading psychology is your driving skill. It determines how far you can go. Real story: Douglas once coached top fund managers who, despite their success, struggled after consecutive losses. They had to go back to trading tiny positions, from 100,000 shares down to 1,000, to rebuild confidence and discipline. Even professionals must constantly train their psychology. Practical exercises to reshape your mindset. Based on Douglas's teachings, here are concrete steps to strengthen trading psychology. Understand your edge. Determine your method's win rate, e.g., 60% over 100 trades. Accept that losses are normal and not personal. Trade in sample sizes. Commit to at least 20-50 trades following your rules exactly, regardless of results. Evaluate performance in aggregate. Start small. Trade tiny risk amounts, e.g., $2 per trade. When you can trade without stress, gradually scale up. Keep a trading journal. Record your emotions after each trade: fear, excitement, frustration, and note how they affect decisions. Study trading psychology content. Watch videos on Mindful Trader channel to deepen your mental control skills. Conclusion: your path to consistent profits trading isn't a battle of being right or wrong. It's a game of probabilities. To succeed, you need both a solid strategy and a disciplined mind. By embracing randomness, managing risk, and cultivating a neutral mindset, you can close your profit gap and achieve steady results. Remember, each trade is an opportunity to execute correctly, not to prove yourself right. Start small, focus on process, and let your edge play out over time. With dedication, you'll not only trade better, you'll enjoy the journey without stress or disappointment. Are you ready to change how you see trading? Share your thoughts in the comments below, and don't forget to subscribe for more trading psychology insights.